from a surplus in 2016 to deficit in 2017. The U.S. gold market suffered a net deficit this year compared to a small surplus in 2016. This was quite interesting, because U.S. physical gold demand will be down considerably this year. In 2016, total U.S. gold demand was 212 metric tons versus an estimated 150 metric tons this year. The majority of the decline in U.S. gold demand is from the physical bar and coin sector that is down 56% in the first 3 quarters of 2017 compared to the same period last year. So, why will the U.S. gold market suffer a deficit if gold demand is down sharply this year? Well, it seems as if the culprit is the huge increase in net gold exports. Last year, the U.S. imported 374 metric tons amount of gold and exported 398 amount for a net 24 amount deficit. However, this year, estimates for U.S. gold imports will fall to 250 amount while exports increase to 475 amount. Thus, the U.S. net export deficit will be 225 amount in 2017. However, if we look at all the data in the chart above, the U.S. gold market will experience a net 76 amount deficit in 2017 versus a 44 amount surplus last year. Bar's right-hand side of chart. Again, we can see that U.S. gold imports are estimated to decline significantly this year to 250 amount compared to 374 amount in 2016. Furthermore, total U.S. gold exports are forecasted to increase to 475 amount this year versus 398 amount in 2016. When we factor in U.S. gold mine supply, domestic consumption, and gold scrap supply, the market will go from a small 44 amount surplus in 2016 to a 76 net deficit this year. So, the question remains: what happens when the markets crack and retail investors flock into gold ETFs as well as surging gold bar and coin demand? This happened in the first quarter of 2016 when the Dow Jones Index only fell 2,000 points in a few months. Gold ETF inflows surged to the second highest quarterly amount ever at 350 amount. The all-time record of quarterly gold ETF inflows took place during the first quarter of 2009 when the Dow Jones was crashing towards 6,600. During the Q1 2009, gold ETF flows were a staggering 465 amount, while precious metals sentiment is currently depressed due to the surging stock and cryptocurrencies. At some point, we are going to see a crash in these two markets. The amount of leverage in both markets is off the charts. I believe the next market crash will cause more investor fear than ever. We could see gold ETF inflows surge above 500 amount while physical bar and coin demand beat all records. Interesting chart on U.S. mine worker gold and silver productivity. When I was looking at the U.S. gold market data, I came across some interesting statistics on worker mine productivity. According to the U.S. data, the U.S. gold industry employed 12,000 mine workers in 2016 to produce 7.1 million Oz (MOZ) of gold. In the U.S. silver mining industry, 785 workers produced 23.2 MOZ of primary silver. While total U.S. silver production was 37 MOZ in 2016, 13.8 MOZ was a byproduct of base metal and gold mining. In the U.S. 2014 Silver Yearbook, they break down the top silver mines in the United States. There were only 3 primary silver mines in the country. These included the Kerr's Rochester Mine in Nevada, Hecla's Lucky Friday Mine in Idaho and American Silver Corporation's Galena Mine, also in Idaho. The combined silver production from these 3 primary mines was 23.2 MOZ. If we take the number of mine workers and divide by U.S. gold and silver production, we have the following. Each mine worker in the gold industry produced 595 ounces in 2016 versus 29,550 ounces of silver. Thus, each mine working in the primary silver industry in the U.S. provides 50 times more silver than their counterpart in the gold industry. By taking this a step further, each U.S. mine worker produced 1.6 ounces of gold a day compared to 81 ounces of silver. Not only does it take a lot more human labor to produce gold than silver, it also takes a lot more fuel. According to data, I put together for 2014, Barrick consumed nearly 21 gallons of diesel to produce 1 ounce of gold, while Pan American Silver only consumed 0.2 gallons of diesel to produce an ounce of silver. Thus, it takes 100 times more diesel to produce gold than silver. Investors need to understand that the price of gold and silver are based on their cost of production, not the ratio extracted out of the earth. For example, the world produced 886 MOZ of silver in 2016 compared to 104 MOZ of gold. That is a silver-gold mine ratio of 8.5 to 1. Some readers suggest that the price of silver should rise to the same extraction ratio to gold. Thus, that would be approximately $154 silver. However, the reason gold and silver were valued closely to the ratio they were extracted out of the earth in the past was due to the mining method. In the past, mining was done mostly with human and animal labor. Thus, the 10-15/1 historic gold-silver price ratio was valued based on the extraction ratio. Today, the energy we use is mostly from coal, natural gas, and oil. These carbon-based fuels have distorted the cost of production. According to my last estimate, the primary gold mining industry's break-even was between $1,100 minus $1,150, and the primary silver mining industry was $15 minus $17. Thus, the cost of production ratio is 70/1. The gold-silver cost ratio is very close to the current gold-silver price ratio of 76/1. Lastly, the cost to produce gold and silver will no longer function as their market value in the future. The value of most commodities are based on their cost of production, but gold and silver also act as high-quality stores of value. When investors finally realize that their wealth investing in stocks, bonds, and real estate will continue to vaporize when the stock markets eventually crash, then we will finally see silly crypto price moves in the precious metals. Bonus advisory: how to choose a gold firm. Right turns and wrong turns on the road to gold ownership. Some might consider the precautionary checklist offered below a matter of common sense, but in our experience it is surprising how many prospective gold owners simply dive in without much in the way of a consumer inquiry. Your choice of a gold firm can mean the difference between success and failure as a gold owner. Choose the right firm and it will help stay the course on protecting your assets from economic uncertainties. Choose the wrong firm and you can be easily diverted from true gold ownership through a maze of related but speculative and derivative investments. High-end numismatics, leveraged precious metals accounts, created contemporary bullion coins, off-brand bullion bars and jewelry items, gold stocks, precious metals futures contracts or options, and exchange-traded funds all have a gold component as part of their profile, but are no substitute for physical coins and bullion which you own outright. Only gold coins and bullion meet the 4 basic criteria for safe haven status: liquidity, portability, tradability, and appreciability in direct correlation to the international spot gold price. Inherently, there's nothing wrong with owning any of the other investment vehicles just listed as long as you are mentally and financially prepared to shoulder the risks. If you are interested in owning the precious metals for asset preservation purposes, it follows you would be best served by a firm specializing in coins and bullion for delivery. Key criteria for choosing the right gold firm. Apply the tests listed below to your choice of a gold firm, and we are confident you will get off to a strong start. We are confident too that USA Gold will grade at or near the top of your list. 1. Choose a gold firm that has a solid track record. 10 years in business is good. 15 years or more is even better. As gold continues its secular bull market, opportunists are sure to enter the market, resulting in numerous startup gold firms that often close their doors as quickly as they were opened. Firms 15 years old or more have seen both good times and bad in the gold market. As such, they have demonstrated a commitment to the industry that carries a great deal of value to you as an investor. Such longevity shows not only a commitment to the principles of gold ownership itself, but is also indicative of the sustainability of a particular organization, an important indicator when it comes to the ethics of an organization's sales practices, the accuracy of its advice, and its ability to honor its commitments. USA Gold. coins and bullion since 1973. 2. Choose a firm with a commitment to keeping you informed, one that offers information-based services suitable for our information-based age. During your time as a gold owner, much is likely to change in the economic and political landscape. You will want to stay informed, and the mainstream press does not always report prominently on the trends likely to affect your portfolio, or emphasize the articles of interest to you as a gold owner. The usagold.com website. Online since 1997. Our commitment to information services is almost as old as the firm itself. Starting decades ago with our monthly hard copy newsletter, News and Views, and continuing today with our widely acclaimed website, we have dedicated ourselves to providing first-class information services designed to meet our clients' needs. The USA Gold website today hosts almost 1.5 million visits per month, a guiding light and practical resource to its users. 3. Choose a firm willing to spend time with you and answer your questions. The firm that is abrupt at the outset is likely to give you short shrift if you have a question or concern that needs to be addressed in the future. Be wary of companies that use aggressive sales tactics. Seek out and develop a relationship with firms that handle your inquiry in a friendly, professional manner. Choose a firm with a large and satisfied client base. You will benefit from the experience it has gained working with a variety of situations. A firm that knows its business can help you choose the right portfolio mix to address your specific goals, circumstances, and concerns. Understands the difference between the client-oriented and customer-oriented gold firms. The latter generally compete on the basis of price with little or no attention paid to your particular portfolio needs. USA Gold. A boutique firm with a large clientele. USA Gold is unique among national gold firms in one important respect. By design, we are a boutique firm with a small but highly regarded staff of experienced and knowledgeable client advisors. We have little interest in expensive national media campaigns, a large and unwieldy overhead, and the aggressive sales tactics which usually accompany that business model. Instead, we have gone about in the business of building our clientele, which now numbers in the thousands, through the USA Gold website and by referral from our existing clientele. Our commitment to the gold business spans nearly 40 years and, during that time, we have built and maintained a reputation for friendly, client-oriented service and consistent, level-headed guidance qualities that will benefit you as a gold owner now and in the future. 4. Choose a firm with a high degree of professionalism and commitment to the gold business. The level of expertise in the gold market varies from firm to firm as their general interest in the economy and financial markets. Although there are many outlets for gold, there are relatively few companies with staffs capable of providing reliable direction to the first-time investor. Not every gold firm, for example, has asset preservation as its top priority. Some tout leveraged accounts or high-end numismatics, neither of which blend well with the safe haven aspirations of most gold owners. Then there is always the firm that totally disregards the individualized niche of the inquiring client and concentrates instead on its own agenda. Before you even contact a gold firm, it would serve your best interest to ascertain the real nature of its business. You can learn much by browsing a company's website, something even the smallest firms offer these days. If its product line, services seem a good match, a follow-up call is in order. If not, keep searching. The initial spade work will end up saving you considerable time, effort, and money over the long run. USA Gold. Safe haven for the asset preservation investor. USA Gold carries the range of precious metals bullion coins and bars and bullion-related historic gold coins that track the gold bullion price. Our unambiguous purpose is to accommodate investors wishing to own precious metals for asset preservation and/or safe haven purposes. 5. Choose a firm with strong credentials and a solid history. A firm that has proven itself to be trustworthy can help you avoid some of the problems, pitfalls, and wrong turns often encountered on the road to gold ownership. One reliable source for investigating a business standing is a Better Business Bureau (BBB) profile, something any reputable gold firm should have. There you will find basic information, the company's BBB rating along with a record of complaints and how they were handled. A history of dissatisfaction, particularly if there has been a large number of complaints, can be a warning sign even if the complaints were settled satisfactorily. USA Gold. An admirable track record for over 40 years. USA Gold enjoys an A+ rating with the Better Business Bureau, and has been granted the right to display the Reliability Program logo. It has not had a single complaint lodged against it for over a decade, and has consistently been awarded the annual Gold Star certificate, which goes to firms that have no complaints over a 3-year period. In addition, the firm is a member of the Industry Council for Tangible Assets since 1985. Michael J. Cazares, the firm's owner, is a life member of the American Numismatic Association, having joined the organization in 1975. When we factor in U.S. gold mine supply, domestic consumption, and gold scrap supply, the market will go from a small 44-mount surplus in 2016 to a 76 net deficit this year. So, the question remains: what happens when the markets crack, and retail investors flock into gold ETFs as well as surging gold bar and coin demand? This happened in the first quarter of 2016 when the Dow Jones Index only fell 2,000 points in a few months. Gold ETF inflows surged to the second highest quarterly amount ever at 350 mount. The all-time record of quarterly gold ETF inflows gold bar and coin sector that is down 56% in the first 3 quarters of 2017 compared to the same period last year. So, why will the U.S. gold market suffer a deficit if gold demand is down sharply this year? Well, it seems as if the culprit is the huge increase in net gold exports. Last year, the U.S. imported 374 metric tons amount of gold and exported 398 mount for a net 24 mount deficit. However, this year, estimates for U.S. gold imports will fall to 250 mount while exports increase to 475 mount. Thus, the U.S. net export deficit will be 225 mount in 2017. However, if we look at all the data in the chart above, the U.S. gold market will experience a net 76 mount deficit in 2017 versus a 44 mount surplus last year. Bar's right-hand side of chart. Again, we can see that U.S. gold imports are estimated to decline significantly this year to 250 mount compared to 374 mount in 2016. Furthermore, total U.S. gold exports are forecasted to increase to 475 mount this year versus 398 mount in 2016. From a surplus in 2016 to deficit in 2017. The U.S. gold market suffered a net deficit this year compared to a small surplus in 2016. This was quite interesting, because U.S. physical gold demand will be down considerably this year. In 2016, total U.S. gold demand was 212 metric tons versus an estimated 150 metric tons this year. The majority of the decline in U.S. gold demand is from the physics took place during the first quarter of 2009 when the Dow Jones was crashing towards 6,600. During the Q1 2009, gold outflows were a staggering 465 mount, while precious metals sentiment is currently depressed due to the surging stock and cryptocurrencies. At some point, we are going to see a crash in these two markets. The amount of leverage in both markets is off the charts. I believe the next market crash will cause more investor fear than ever. We could see gold ETF inflows surge above 500 mount, while physical bar and coin demand beat all records. Interesting.